Hello and welcome. My name is Adam Braunscheidel, and I am a wealth advisor at OJM Group. In this month's on-demand webinar, I will discuss the importance of time in the market, especially given recent market volatility, and outline a few reasons why market timing strategies are often unsuccessful. It's important to note that this video is for informational purposes only, and the information may not be suitable for your personal circumstances. Please contact a professional before attempting to execute any of these strategies. I also wanted to briefly introduce you to a number of our books that principals and members of the team have written here at OJM Group. If you find this information helpful, we encourage you to check out one of these books. We'll discuss how you can get a free ebook download or even a hard copy of the Wealth Management Made Simple or any of the other books you see here on the screen at the end of the presentation. So just laying out the agenda for today, this is really what the themes are that we're going to walk through. I did put a quote on here from a well-known advisor in the field. He says, Cliff Asness of AQR, "You do not want to make a career trying to beat the stock market based on whether it is cheap or expensive." So really around the timing parameters and trying to time markets based on those factors. So we'll walk through just the current interest rate environment, inflation environment, talk about why it's important, how long you're invested in the market, not necessarily timing the market, and then really outline some reasons or why we think it's important to have a process in place, and taking that a step further, why you need to stick to that process in difficult times. So starting off with the first slide, this is really a depiction of how low interest rates have impacted safer investment vehicles. So you can see on the left side there, it's what an investment in a 6-month CD, more of a conservative vehicle, has done. While low interest rates help individuals on the debt side, it leaves investors with little choice of where to park short-term or risk-averse funds. Think about yourself personally and what you're actually being paid in the current environment in your savings account at banking institutions. I guess it's probably pretty low. And in fact, during the volatile fourth quarter, we fielded numerous calls from clients wondering if they should rotate out of their globally diversified portfolios and go into 100% cash or a vehicle such as this that you see on your screen. After all, coming off the fourth quarter, we hadn't witnessed that bad of a quarter in a very, very long time. So it was top of mind for most folks. Aside from the added cost of transitioning a portfolio to 100% cash, there's taxes, transaction fees. There's also behavioral implications that impact the investor. Let's say an investor decides to move their portfolio to cash. They must be prepared to sit and watch on the sidelines as the market reaches new highs or continues to move higher. In fact, look at what the market's done the first quarter of 2019. Stock market's up over 13% to start the year through mid-March. And really, this dilemma that investors face has nothing to do with cash as an investment option, or really the current stock market valuations or opportunities cash can bring about in a market crash or correction. Those things are important to understand, but they really don't matter if thinking about them causes you mental anguish and leaves your feet stuck in the mud. It's more about having the ability to get over the fear of allowing market forces to stop you from implementing an investment plan. The other issue with transitioning your portfolio to cash is that when timing the markets, you must be right not only once, but twice. The real question is, when is the most opportune time to get back and re-enter the market after you've gone to cash? In hindsight, we know when the market reaches its low, but in the moment, there was no white flag being waved to say, hey, time to get back into the market. Think about March 2009. No one was waving that white flag to say, okay, Mr. Investor, time to get back into the market. No one can consistently call tops and bottoms. So really, you should focus on an investment process that provides you some level of comfort across multiple market scenarios. Money sitting idly by in bank accounts is currently earning minimal interest, as we discussed on the previous slide. You could even argue, actually, that you're losing money or eroding your purchasing power because of the impact of inflation. I mentioned even most investors today that we still talk to aren't even earning above 1% with their cash savings accounts, which quite honestly, it's a whole other discussion for another time in terms of trying to utilize other institutions that have higher rates for your savings accounts. For example, as I lay this scenario out, the real rate of return for an investor earning only 0.5% to even 1% on their cash savings, while inflation sits near 2%, is actually negative. Foregoing returns in the interest of safety simply will not deliver the returns you need to achieve your long-term goals. In fact, it would take a U.S. investor 35 years to double his or her money if you're sitting in cash, assuming a long-term rate of return of 2%. Quite frankly, that's just not going to get it done. As we move along here, you can see the convergence of rates versus yields over the past 60 years. The spread has narrowed, meaning it's much harder to achieve the levels of return that investors came accustomed to during higher interest rates environments from your cash, even your fixed income positions. Just like to point that out. Here's another chart that helps depict what inflation has done here over the last decade, since the middle of our financial correction back in 07 to 09. When you see blue, the darker the blue shade, the more that signals that inflation is lower than the longer term average over this time period. When you see red highlighted, that means it's higher than it's been, higher than the average inflation. So as you can see, inflation is actually around the globe pretty low relative to longer term averages. So we can expect that inflation should, over the next decade, start to pick up. Going back just over 10 years, investors really haven't experienced all that much volatility outside of the 07-09 correction, which you can see here with a big spike. Actually, 2017 was a historic year from a volatility standpoint, since there wasn't an intra-year decline of more than 3%. And if you go back multiple decades, the average is typically around 14%. So in that market environment, times have been good. Investors tend to get complacent and get used to not seeing wide dispersions in the market, even though those are the norm. I like to show this slide to investors because here you can see, going back really to World War II, you can see how large of swings we've had from recessionary times, whether it was an actual recession or it's just a large correction. You can call it bear market, which is greater than a 20% decline. Just shows those in a way, and really it just depicts that these are difficult times. They're scary moments, especially when the market's down beyond that bear market. Keeping that in context, though, it's important to see how little impact those large market corrections actually have had over time. Right? You can see the gray highlighted bars there, the columns, are those recessionary time periods that we just depicted on the previous slide. In the grand scheme of things, you can see they're really just a blip on the radar. I actually like to walk clients through this scenario. Kind of picture this. It's March 8th, 2009, so almost a little more than a decade ago now. The market's down 56% from its all-time high. Unemployment's over 8%. It's heading lower. Real GDP is at 6.2% annualized in the fourth quarter of 2008. It felt like the world was coming to an end. Everybody was rushing to the exits. You're tired. You're exhausted from living through this. Let's just say in that moment you fell into a deep sleep and didn't wake up until today. Would you believe that the S&P is actually up over 305% since the bottom on a price perspective? Most people would probably be blown away with that, and certainly no one in that moment in real time would have envisioned the scenario that played out over the next decade to come. But it did happen. This is why we stress the importance of staying invested. And here's a graphical numerical way that Morningstar has come up with to illustrate this. Investors who attempt to time the market run the risk of missing periods of its exceptional returns, the last decade, leading to significant impacts on the ending value of your portfolio. So the image above illustrates a $100,000 investment from 07 to 2018. The value of the investment dropped to $54,000, a little over $54,000 by February 2009. If an investor remained in the stock market for the next decade, so for the next 82 months, the value of their portfolio would rise from $54,000 all the way up to just over $238,000. On the flip side, if that same investor exited the market at the bottom to invest in cash for a 1-year time period, so rotated into that cash bucket for 1 year, the ending value of that investment would be $155,000. So they missed out on $83,000 of potential gains by deciding to move to an all-cash portfolio. An all-cash investment at the bottom market would only yielded that $54,580. Drown out the noise. It's important to not focus on the narrative and stories in the short term. Market movements are notoriously difficult to predict. The media outlets will scream the loudest. They're not always the most accurate. Really, the fallout from attempting to time the market, just look back at that previous slide, it's significant dollars. It's important that you look, pay attention to your portfolio, but you don't stare too closely. It's kind of like the old adage, when you're a kid, don't sit or stare too close at the television screen. It's important for investors to know the performance of their accounts, but short-term fluctuations can be quite volatile. And this really depicts that the probability of realizing a loss with any given day is high, but over time it decreases. Just look at the green bar, stocks, a range of down 39 to up 47% on a 1-year basis. You extrapolate that out over a 20-year rolling time period, the lowest return is 6% on stocks versus 17% on the upside. So the range of returns, the dispersion really narrows the longer time horizon you have. Investors would love to find an easy way to tell them when to get out of the market to avoid an oncoming train on the tracks, especially at today's elevated valuation levels. Unfortunately, valuation is not going to do that for you because expensive markets can always get more expensive. Fundamentals can change. No one really knows what level of valuations will cause investors to change their perception of risk until after the fact. Valuations can be useful for setting expectations, but not timing the market. There's reason why investors tend to only hear about looming market doom or imminent market growth, because really these news outlets, the ones pushing these stories, have an incentive to draw viewer attention with wildly bullish or even wildly bearish predictions, because these sensationalized views can really be a distraction to an investment approach. You can be tempted to make radical changes based on these headlines, but it's important to recall the basic fundamentals and what your plan or process is so that you can stay on track and not fall off track with all this noise. One option that our team employs to combat this psychological trap is by maintaining a diversified portfolio across multiple asset classes. Asset allocation is a helpful proven tool to mitigate large drawdowns in the market. In past sell-offs, bonds typically have performed well relative to stocks. The dispersion of returns is much more narrow in bonds than it is stocks over the historical periods. That's why we still have our client portfolios with exposure to bonds, even though, going back to our original slides, interest rates are as low as they are. For us, will the markets become harder to navigate in the years to come? Seems pretty reasonable given the returns we've enjoyed over the last decade. But getting harder tomorrow doesn't imply that it's easy today. There's no such thing as easy in investing. Stay focused on the long term. Investors who have taken the time to determine a sound investment plan based on your long-term goals, your risk tolerance, are best advised to stick to the plan. It's counterintuitive to human nature. You're a lot of times better off doing nothing than making drastic changes. While it may not always grab headlines, this sensible, tailored investment plan may be the best solution to meeting your long-term retirement goals. So don't get cute. Even if you're better than average, you just aren't going to get much out of it. Just focus on your savings, get back to work. Have a realistic process in place and stick to it. To me, the best plan is one that you can maintain despite what is transpiring around you around the globe. This concludes our presentation today. Thank you for taking your time for listening in.
OJM is a multidisciplinary wealth management firm, and we've worked with over 1,000 clients throughout the country. We work in 3 different divisions for our clients: investment management, consulting, and insurance benefits. We would welcome the opportunity to speak with you about how we might be able to bring value to your wealth planning. As I mentioned at the beginning of the webinar, our principals have authored several books, all of which are available to webinar viewers at no charge. You can get a free hard copy or ebook download for Kindle or iPad by texting OJM Web to 555-888. You can also visit ojmbookstore.com and enter the code OJMWeb at checkout. In addition to a free book, OJM Group also offers webinar viewers a complimentary consultation where we can answer your questions and see if our firm might be a good fit for your situation. Visit ojmgroup.com or call 877-656-4362 to schedule your free consultation. Enjoy the free copies of our books, and we hope to have the opportunity to speak with you. Thanks for watching.